In this video, I'll explain what dividend yield, price to earnings ratio, and earnings per share are, and how these three key investing criteria apply to fundamental investing. We know that fundamental analysis provides lots of important data, but is a time-consuming process. Luckily, there are three key investing criteria that can fast-track your decision-making process. These are dividend yield, price to earnings ratio, and earnings per share. Now, a dividend yield is an income an investor receives from the share expressed as a percentage of its current market price. A dividend yield can be expressed with the following formula. Annual dividends per share divided by the current share price multiplied by 100. So if a share was priced at $2 and was paying a dividend of 20 cents, its dividend yield would be 10%. 0.2 divided by 2 multiplied by 100 equals 10%. It's important to remember that the price that you pay for the share locks in the dividend yield. For example, if you pay $2 for the share and the dividend is 20 cents per share, we know you get a yield of 10%. If the share price then rises to $4, the dividend doesn't change. It still pays 20 cents per share. But the yield is now 5%, as 0.2 divided by 4 multiplied by 100 is 5. However, as you purchase the share for $2, you still get a 10% yield. When a share price falls, the dividend yield rises and therefore becomes more attractive for investors seeking growth and income. On the whole, companies that have good histories of paying good dividends are profitable. Therefore, any decline in price will only be short-term and will soon return to long-term growth. So for investors seeking a growth and income portfolio, a dividend yield above the average of 4% is good. Now, most blue chip companies offer the dividend yield as fully franked, meaning they have already paid tax on it. What this means is a 4% yield is actually worth more like 6 to 7%, as you can claim a tax rebate on the dividend payment in your annual tax return. If you compare a potential dividend payment of 7% net, you can see why investors are keen to buy shares over simply putting cash in the bank and perhaps getting just 3 to 4% returns. One thing to note, always be wary of a very high dividend yield. This suggests the share price may be falling and may not be a wise investment. So a price to earnings ratio provides investors with an indication of a company's growth prospects. The ratio is based on the relationship between the share price and the earnings of the company. A low PE ratio indicates a company's share price is undervalued, while a high PE ratio indicates a company's share price is overvalued. To calculate a PE ratio, you divide the share price by the earnings per share. For example, if we look at Commonwealth Bank here in Australia, we would divide 127 by 5.76, which gives us the answer 22. When a PE ratio is low, this may mean a company's profits are rising or the share price is falling. The ideal scenario is that the PE ratio is falling in line with the news that a company's profit forecast is up. Now, because a PE ratio is a historical measure rather than a projected measure of a company, it's important not to use this metric in isolation. Always compare the PE ratio with other companies in the same sector. A low PE ratio suggests the share price may be undervalued and presents a good opportunity. When looking at PE ratio of a company, a score below 15 is preferred. Therefore, if we consider Commonwealth Bank has a score of 22, this suggests that this bank stock is currently overvalued. Now, earnings per share is used to indicate the profitability of a company over time, and compared to PE ratios, offers a better indicator for future growth. EPS is calculated by dividing the average shares outstanding by the company's net income. It's a good idea to check a company's historical EPS score over the last few years. Ideally, you want to see the EPS has increased over time, showing that the company is growing and delivering profits to its shareholders. To evaluate if a company will offer future growth, you can examine the current EPS score and compare it to the forecasted EPS score for the next few years. For example, if you're a short-term investor, you would look at the 1-year forecasted EPS score and compare it to the current EPS score to calculate EPS growth as a percentage. So using Commonwealth Bank as an example, we can calculate the 1-year EPS score minus the current EPS score and then divide by the current EPS score. Then multiply by 100 to get the percentage growth. So based on this calculation, Commonwealth Bank's short-term growth is neutral. Remember, EPS data is available from most brokers and is often published in financial newspapers too. So those are my tips on dividend yield, PE ratio and EPS. If you want to know how to use these key metrics to pick the best growth and income stocks, check out this video on how to complete a top-down analysis.